Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Microsoft.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's get right into it because I have been staring at the market reaction to this earnings report for the last 24 hours, and I feel like I'm taking crazy pills.
You are definitely not alone in that feeling. It's a classic case of market cognitive dissonance.
Right. We're looking at a company that is fundamentally rewriting the rules of technology.
Yeah.
Yet the market seems to be punishing them for it.
Exactly. You're seeing two completely different narratives playing out, at the same time on the same ticker symbol.
So just to set the stage for everyone listening, it is early February 2026.
Right. Microsoft just dropped their Q2 numbers for the fiscal year 2026.
And on paper, they crushed it. They beat expectations across the board. Revenue is up. Profits are up.
Flawless execution.
And yet, the stock took a nosedive. It dropped about, 6% right after the report. So help me unpack this. Why is the market punishing a winner?
It really comes down to one specific tension, a battle between record-breaking revenue and just absolute anxiety over how much money they are spending to get it.
The elephant in the room. The capital expenditure, the CapEx.
That's it. Investors are looking at the bill for this AI infrastructure build-out and just getting sticker shock. They see the money leaving the bank account today and they're panicking.
Even though that money is building the factory for tomorrow.
Precise.
It's that classic short-term versus long-term struggle. But before we get to the scary spending numbers, and they are big, we will get there, we have to look at the money coming in.
Yes. That context is vital.
Because if you're spending a fortune but making peanuts, that's a problem. If you're spending a fortune to build an empire, that's a different story.
A very different story. And in this case, the fundamentals are genuinely impressive. For Q2 fiscal 26, Microsoft reported revenue of $81.3 billion.
$81.3 billion, and that's up 17% year over year.
17%.
Let's just pause on that for a second. For a company of this size, 17% is massive. That's a titan moving like a sprinter.
That's a great way to put it. And the bottom line looks good, too. Earnings per share came in at $5.16, which, beat the street's expectations.
So operationally, the machine is humming.
It is. Operating income rose 21% to $38.3 billion. They're becoming more profitable, not less.
And the engine for all this is still the cloud, right? Azure. Is it still doing the heavy lifting?
It's doing more than heavy lifting. It's practically carrying the entire market sector. The intelligent cloud segment brought in $32.9 billion, up 29%.
Okay, but here's the key stat I'm looking for.
I know which one. Azure and other cloud services grew 39% year over year.
39%.
Oh.
Is that accelerating? I feel like that's higher than it was a year ago.
It is accelerating. And what's fascinating here is why it's growing. We're seeing the direct monetization of AI. The data shows that AI services specifically contributed 16 percentage points to that growth.
Wait, hold on. Break that down for me. 16 percentage points of that 39% growth came purely from AI.
Purely from AI. If you strip out AI, Azure is growing in the low 20s, which is still healthy, but, normal.
Mm-hmm.
AI is the turbocharger.
Wow. And they aren't being shy about their targets either.
Not at all. Microsoft stated they're aiming for $25 billion in AI-related revenue just by the end of this fiscal year.
$25 billion. I mean, that's the size of a Fortune 500 company, just from this new layer of tech that barely existed at scale 3 years ago.
And it's not just the raw infrastructure, it's the software layer, too. We have to talk about the moat.
Right, the sticky ecosystem. Microsoft 365. The big question last year was Copilot. Was it just a novelty or would people actually pay for it?
Well, it's gaining real traction. They now have 15 million paid seats for Copilot embedded in Microsoft 365.
15 million paid seats. That's a significant adoption curve for an enterprise product.
It is, and it feeds directly into their productivity and business processes segment, which hit $34.1 billion in revenue.
Okay, but I imagine the critics are asking, is that enough? Is demand slowing down?
That is the fear. That's the bear case. But the data in this report says the opposite. And this, to me, was the most shocking number in the entire report, the RPO.
The remaining performance obligation. Okay, so for everyone listening, that's the backlog, right? The value of contracts that are signed but not yet delivered as revenue.
You got it. It's essentially future revenue that is already locked in legally.
It's a crystal ball. So what's the number?
Their RPO is currently sitting at $625 billion.
600. And 25 billion.
Yes, and it's up 110% year over year.
Whoa, okay, stop. That is enormous. That's more than $500 billion in future revenue already locked in.
It's multiples of their current annual revenue, and that is why I'm not panicking about the current stock drop. A backlog growing at 110% tells you customers are doubling down.
So the stock market is jittery, but the actual customer base is aggressive. That number implies demand is outstripping supply.
That's exactly the situation. They are supply constrained, not demand constrained, which leads us directly to the bad news.
Right, the spending. If the backlog is massive and revenue is growing, we have to go back to why the stock is down 25% from its highs.
It is absolutely the spending, the elephant in the room. In just this one quarter, Microsoft's capital expenditures were $37.5 billion.
$37.5 billion in 3 months. That's more than $1 billion a day.
Yes, up 66% year over year.
That is eye-watering. Where's all that money going?
Two-thirds of it is going directly into hardware, GPUs and CPUs to build out their AI infrastructure. But it's also the data centers themselves, the concrete, the cooling.
So they are betting the farm. They are going all in.
They're on a $145 billion annual run rate for AI spend. It's the largest infrastructure build-out by a private company in history.
And that is what spooked investors. They see $37 billion going out the door and get nervous about margins. It's like buying a house and immediately spending the same amount on renovations.
That is a great analogy. The market is looking at the renovation bill and forgetting about the future rent checks.
But can they actually afford this without putting the company at risk?
Surprisingly, yes. The balance sheet is incredibly robust. Even with the spending, their GAAP net income was still $38.5 billion, up 60%.
So they're still profitable.
Very. And get this, they returned $12.7 billion to shareholders in dividends and buybacks this quarter.
So let me get this straight. They are spending $37 billion a quarter, and they still have enough cash left over to pay shareholders $12 billion.
That's the flex. It shows they're self-funding this growth. They're paying for it with today's cash flow.
A fortress balance sheet. Okay, let's pivot to the technicals. The stock is down 25% from its peak, took another 6% hit after this report. What do you see in the charts?
I see a valuation anomaly. For the first time in a decade, Microsoft is trading cheaper than IBM.
Really? Cheaper than Big Blue? That's a massive psychological signal.
It is. It suggests the stock has entered, deep value territory. The market has beaten it down so much over these CapEx fears that we are likely finding a floor.
So it's a psychological base, so to speak. The disparity between the valuation and the growth is just getting too wide to ignore.
Exactly. We're seeing intraday price action where the stock dips but then gets bought back up aggressively. The big institutional money sees this as an opportunity.
That brings us to sentiment. If I'm looking at the news headlines, what's the mood?
I would score the current sentiment as neutral. A flat 0, it is a complete tug of war.
What are the two sides pulling on the rope?
On one side, you have the post-earnings weakness camp. They're freaking out about the $37 billion spend. They're focused on cash outflow.
And the other side?
The AI upside camp. They're looking at the co-pilot seats, the cloud growth, and that massive backlog. They're focused on revenue inflow.
And this isn't just about Microsoft, right? The headlines are full of anxiety about the total big tech spend.
Correct. The estimate is that the major players will spend between $515 to $650 billion on infrastructure in 2026 alone.
$500 billion. That's an industrial revolution level of investment.
It is. But we are seeing bullish analyst notes starting to trickle in, framing this drop as a buying opportunity.
So looking forward, what's on the calendar for the next 3 months? What's the next big checkpoint?
That would be the Q3 earnings, likely in late April. The consensus is continued acceleration in Azure and AI. If that 39% growth ticks up to 40%, the bear case just falls apart.
Any other catalysts? Macro trends?
There's the big macro tailwind we call the cloud rotation. Companies are realizing they can't run modern AI on their own servers. It's too expensive. So they're forced to rotate to the cloud.
So if you want to play in the AI sandbox, you have to pay rent to the person who built it.
Precisely. And there's one other wild card. Potential U.S. big tech chip tariff carve-outs. If the government decides AI dominance is a national security priority, it could make that big spend a little more efficient.
That's an interesting angle. Okay, let me play devil's advocate. What is the actual bear case? What could go wrong?
The biggest risk is margin pressure. If they spend $115 billion on capex, but revenue growth slows down, margins get crushed. They're left with expensive, depreciating assets.
And what about execution risk? Can they actually scale Copilot?
That's the AI diffusion risk. If businesses find that the productivity gains aren't worth the subscription cost, that growth engine stalls.
But you have a counter-argument to this.
I do. My counter is that these risks are already priced in. Remember the IBM comparison. The stock is effectively priced for failure, and the ultimate safety net is that $625 billion backlog.
Right. Even if sales slow to zero tomorrow, they have years of work already on the books.
Exactly. That backlog acts as a buffer. It gives them time.
Okay, let's wrap this up with your final verdict. Where do you land?
I'm giving this a bullish score of 9 out of 10.
9 out of 10. That is incredibly high, considering the stock just dropped.
It is high because the stock just dropped. My target horizon is a multi-year hold into AI monetization. You only get these opportunities when everyone is worried.
Give me the elevator pitch.
Microsoft has the most integrated AI stack in the world. They're on track for $25 billion in AI revenue this year. The stock is down 25% from highs, offering a discounted entry for a company growing its core cloud business at nearly 30%.
And they're self-funding it all.
Self-funding the build-out, paying dividends, and sitting on a backlog that grew 110%. The market is panicking over the construction noise and ignoring the skyscraper being built.
Panicking over the renovation costs and ignoring the future rent checks. I like that. It perfectly encapsulates the tension.
It's all about your time horizon. If you're investing for 2030, this looks like a gift.
Well, that leaves us with a lot to think about. I want to leave you all with one final thought to mull over today. Everyone is obsessing over the $37 billion Microsoft spent this quarter. But if that $625 billion backlog is real, are we currently looking at the cheapest Microsoft stock we will see for the rest of the 2020s? Think about that. Thanks for listening to Smart Wealth with Joshua.
See you next time.